Music is playing. What's up, everybody? Welcome here. You got to get my favorite Moon Dance and Van Morrison, and here we are, and we're gonna have a good show, have a lot of fun, and of course, if you don't know, I'm going to be doing this every Tuesday and Thursday, um, and we will, do basically we'll freelance the entire show every day. If you got questions, you can ask them. If you got stocks you want me to look at, we'll look at them. We can talk about anything you want, and I'll go through what I see going on in markets. And of course, I think the big story for this week was the debt downgrade from Fitch on the United States debt, and you can think of that as you will. But we only really care about markets, right? I mean, we're worried about trading. I'm going to show you some. Let's see here. I got to remember what to do here because I got producers. I got the whole ball of wax here. Anyways, so when we look, we're looking at price action. That we don't care about anything else but what is the price action in the market. Because if you look at what happened on Tuesday night when Fitch downgraded the debt, most of you probably thought the market was going to get creamed and collapse. Well, it really didn't get creamed or collapse. It went down, but it didn't really get down or get hammered what you might have thought it would. I mean, here we are. If you look at the S&P, you're not even at support yet. Okay, you're just now touching support. So you should take that as a hint and a clue that the markets themselves are not that weak. I mean, you may not like them. I may not like them. I mean, I do believe personally that at some point, and who knows when, and this is the problem, that we're going down 50 to 70%. But that doesn't mean it's going to be today. And the markets had every reason to sell off and get cooked, and they didn't. Think about it. Yesterday, right after the news, they were down. The Dow was down less than 1%. The S&P was down a little bit over 1%. The Nasdaq was down 2%. Not a very big sell-off when you consider how far we've rallied this year. Okay, so again, forget about your opinion. Forget about the news. Everything is developed and right in front of you within the price action that you're watching. So here we are, we're looking. So if I'm personally looking to make a trade right now, okay, and I'm not saying that I am, because you'll hear dings if I make trades, because I am live looking at 6 different screens, and a lot of times you'll see the side of my head because I forgot to look at the camera or forget to look at the camera. But again, I'm doing things as I'm teaching and sharing ideas with you. I'm looking at markets, okay? And right now, if I were to do anything right now, which I am not, but if I were going to do anything right now, I'd be looking to be a buyer. And I don't like the market, but I would be looking to be a buyer. Because why? Well, just look at the trend. Look at the overall price. Here is the S&P. Okay. Here is the Nasdaq. Okay. And just below the first support, but hovering. Okay. Here is the Russell, and here is the Dow. So you tell me where in any of these markets that you should want to be a seller. Okay. That's something that you have to understand and look at. As a trader, you have to look at the markets objectively. You cannot look at them with an opinion. You can't come in saying, well, the market's going to go down. Remember one thing. The market is always right. Okay. I don't care what the news is. I don't care what you think of the administration. I don't care what you think of this. I don't care what you think of that. The price action, and they used to call it the tape before all this technology. One of the things about being a market maker on the trading floor was you didn't have charts. You didn't have time to look at things. You had to make decisions in less than 1 or 2 seconds. And you had to convert fractions, because we didn't use decimals, and make a decision whether you wanted to do a trade or not. So you had to know how to read the crawler or the tape that was going across, right? That's how you formulated the chart. Well, now you have the advantage. You can look at charts, but you can't tell the market what to do. If you tell the market what to do, you can assure yourself of one thing: you'll lose all your money. Okay, that I can guarantee. That if you continue to tell the markets what they should do, guess what? You are not going to be a happy camper. You are going to lose your skin here. Okay, it's the way it is. The market is always right, and those who fight it end up in the toilet. And I will say this to you, that when I had guys that worked for me, the minute they would tell me the market was wrong, they got fired. Okay, because the market is never wrong. The market is an inanimate object that trades. Okay, that is designed to go to take care of all the buyers and the sellers that create this footprint that we're looking at. And it doesn't matter if I'm looking at a daily or this morning, and we had a big morning trading futures today, or in the futures market. Okay, because again, here's a 4-minute cycle. These are 4-minute charts that we're trading from here. Okay, and I use 2 time frames. Here's 4 and here's 1. Okay, the 1 is what we call the trigger time frame. The 4 identifies a trade. And if I'm looking at this right now, there's no trade right now that is setting up that I'd be looking to do. Okay, I would need a lot more volume, for example, in crude oil to be a potential seller. I'd be looking to sell or buy an extension in either direction right now. But that's a very short-term trade, which also has a stop placed in it. When I'm trading options over a longer period of time, I don't use stops. I will set up trades that have built-in stops into them, right? I don't take naked options, whether I be a buyer or a seller. Whatever I'm going to do, there's going to be a combination of 1 or 2 options extra that'll be long. I will never be naked short. So I would do a back ratio. I might do some calendars, some diagonals. Again, there's all kinds of different trades you can make, all right? But you have to decide what is your overall time frame that you want to be involved in it, and what is it you're trying to accomplish, and what is it you're seeing in the time frame that you're watching. Those are what's important. Nothing else is as important as what I just told you. Okay, because all the fancy bullshit out there that promise you billions is all garbage. There isn't any that. There is no such animal. Okay, the only animal is the person controlling the trigger on their mouse like this. See my little mouse here? Okay, there's I'm the guy who's controlling it. Okay, so when you look into trading, who is the enemy when you're trading? Well, I will tell you this: look in the mirror. There you'll find enemy number 1. Okay, public enemy number 1 used to be the FBI show, right? If you're the issue if you're having problems, because again, the person making the decision is not following the footprint if they are getting beat constantly. They are too much involved and worried about what their opinion is. And I think what you'll find out is that your opinion is almost always wrong. And opinions are like, you can fill in the blank, but I think you sit on it. We all got one. Okay. So remember that the markets are the markets. They're going to do what they do, no matter what you think. Okay. The only thing that can happen is a news item that we cannot account for, which would be a war that just broke out this morning. Nobody knew. Well, I knew because I said it for the last 3 weeks, that Saudi Arabia was going to cut the price on crude oil. Okay, not cut the price, but cut production. And sure enough, okay, this morning Saudi Arabia at it was about 8 o'clock Central, 9 o'clock Eastern. Saudi Arabia cut production. Okay, 1 million barrels a day. Well, what happened? Well, the market went straight up. Okay, and of course the overreaction to the market, bang. And that was a news item that nobody knew was coming, or nobody could really account for. So you got a very large move in a very short period of time. Okay, and bang, here we are. So now they're taking another run up, and now there may be a potential opportunity. If I go back to my normal trading time frame, that I may be looking to be a seller. But again, without volume and without price movement, I can't do anything. I need both events to be a part of it. Price and volume have to go in concert. I need a heavy volume and a big swing one way or the other. Okay, and I will take either side of that market. Okay, I don't care. Again, this is a short-term trade, and this is the only trades that I will use stops in. Okay, is because I'm buying or selling a future, and I'm going to trade that future, and whether it be a sell of a spike up or a buy of a spike down, it's immaterial to me. It's just another trade. And it's interesting. When we do this, I trade for an hour in the morning with my members. Okay. And you're looking at these charts. So if you know I'm trading on 4 minutes, well, in 4 minutes, there's 15 opportunities potential in 4 minutes, right? So if you take 15 times 8, in theory, there's 120 potential opportunities within an hour. Well, markets have been so bad that we've been lucky to get 2 or 3 a day. And that's the issue. Yesterday we lost money. We had a bad day. After making money every day, every single day in July, we made money. We had a bad losing, not bad, but we had a losing day yesterday, okay, which was ugly. But at the end of the day, it's not, I don't care that I lost the money. I care that there wasn't enough action or enough trade for me to make another trade. The more trades you can make if you're trading properly, the higher the probability is that you're going to make money. Okay. But again, we need opportunity. And the slower markets are, the less activity that is happening. Guess what? You're probably better off walking away, because I assure you that people have a tendency to make a mirage out of things and see things that do not exist. Okay. And that is something that is that you must remember as a trader, as an investor. Okay? Activity is your friend. Volatility is your friend. Now, not the ridiculous volatility when markets go nuts and the VIX climbs to 1 billion, but normal everyday volatility. We would like to see it higher than it is now. Yesterday's a little bit of a spike. Now, this is never real healthy for a trader. We want more of a steady climb to volatility. You get these volatility spikes, and what would be your guess? I've been a big advocate the last few weeks of saying you got to be long vol right now. Okay, now some are already short vol, some are long vol, but the probability stated that you needed to be long volatility. Okay, and of course we got the move. So now what? Well, I would suspect, based on as fast as it went up, there's probably a little bit of a volatility collapse coming. Now, what'll create that collapse as well? You've got a jobs number tomorrow. Okay, at 8:30 Eastern tomorrow, the government will deliver the jobs number, and it'll be some bullshit number, but it'll be what it'll be. The number will be the number, whatever it is. Okay, and the markets will react on it. But what you have to remember is that a big percentage of tomorrow's move, or what tomorrow's number is going to be, has already been priced in today and yesterday. Big firms have already been positioning themselves based on what their calculations are of this number. So when you look at the volatility, and it would be no surprise to see volatility fall. And interestingly enough, okay, the volatility index is up a little bit, but it was up at over 17. We're now down $1 from the tip of volatility, which tells me that there's a fair chance that the market could actually probably close up today or flat anyways. Okay. And again, I'm not guaranteeing anything. I'm telling you that's what I'm looking at. And based on a VIX that is starting to fall apart, and based on that, I see markets starting to come back a little bit. Okay. And you can see that here's the Dow, which appears so far, it appears to have found a bottom around 35 something. The Russell appears to have potentially found the bottom. The S&P. And again, these could all get violated. I mean, again, there's no guarantee that this is it, but it does appear that they have seen some sort of a bottom and look like they could be charging higher. And if I were going to be an active trader today, which I'm not, I mean, full disclosure, I have no interest in the action here. Typically, the day before a jobs number is quiet anyways. We're in a quiet market. I mean, just look at the overall net volume that we've been trading over the last for months, but look at the last couple of weeks. Look at how many days are like holiday volume. Okay, so when you're looking at that, so what you have to think about is where is my edge? Where's your edge if you have no action? Okay, you don't really have one. And the whole key to trying to trade or be a trader is to have or build in some sort of an edge to your trade. Now, it doesn't guarantee you a winner. Okay, remember, you're guaranteed nothing in the world of trading. But if you set yourself up in the best position, and for those of you who might play poker, obviously hands have different values. Okay, and if you're always in the highest probability or attempt to be in the highest probability, it means that more often than not you're going to win. You're going to have losers. If you don't have any losers, you're not taking enough risk. You're not making enough money. Okay, you have to be willing to take risk to make real money. Remember, trading dollars made is much better than a job. even though it is a job, and so to speak, at least for me, it's a job for 44 years. So you have to remember that if the game isn't playing according to what you want to see, then it's probably better to walk away. Because with the worst thing you can ever do to yourself is find something that doesn't exist, but because your mind starts to play tricks on you, because you start to think about things, and you start thinking about the news, and you start to think about this, suddenly you're making a bad trade. Okay, now you may make money on a bad trade. Again, just because a trade was bad doesn't mean it's a losing trade. But what it does mean is that you're putting yourself behind the 8 ball. And when you do that, what you've created is potentially a bigger problem for yourself. And trust me, you keep making that same mistake, you get problems. So as we look, you can see, I think Apple's got earnings today, right? Apple's got earnings today, and I believe Amazon's got earnings today. So everything sets up that the market should be fairly choppy until probably after the close. In your opinion, what would have been a good option trade to act on your suspicion that the Saudis are going to cut oil production? Well, I would have actually bought oil futures or the micro oil futures, or you could have bought, if you trade futures options, you could have bought options on crude, okay? Or you could have bought the XLE, which is something that we trade anyways. XLE, here, nicely popping higher. So, anything that is related to the oil space, any of the, I'm assuming, again, I'm making assumptions that I haven't even looked at, but I'll assume Occidental Petroleum was probably okay. I popped up pretty sharply. So again, any of the oil companies, and again, what you really want to look for if you're going to make a trade like that is you want to look for an option that has the most liquidity. Okay, you want the best bid offer spread, and you want the most moderate, IV or implied volatility. Now typically most of these companies are big enough; they're not going to have a big spread in volatility. Certainly not XLE or Occidental. But again, that would be the way, and the trade that I would have made had I suspected something was happening, is I would probably sold a put spread, okay, a deep in the money put spread, creating a synthetic call, okay, which we'll get into at a later date. Obviously, we'll learn or try to learn a lot of strategies over the time we're together twice a week. How to use different strategies, why certain strategies make more sense at certain times. Again, to me, I never want to be a straight call or a straight put buyer. In fact, really the only time I buy straight calls or straight puts are if I'm making an expiration play at 15 minutes to the close, and I'm going to buy some option for 12 or 13 cents. Okay, that I'll play. But other than that, I'm going to create some sort of position around there, okay, to give me the best opportunity and not have to worry about, I want to take out as much of the time decay as I can take out of an option. I want to take out as much of the other issues that come out of it. And I also want to be able to sit there and hold it and wait and not think that I got trouble. Knowing exactly what my risk is. Same as when you buy a call, or put, exactly what your risk is. Okay. So again, good question. Are a synthetic call, a poor man covered call, the same straight? No. And I'll answer that question. We're going to step out here for a quick break. Okay. Remember, right below is the subscribe button. Subscribe to the channel so you get the notifications when we're coming on. Okay. And I know that Tradier is building a bunch of other great shows as well. So certainly subscribe to their channel. The button's right below. I'm going to step out here for 2 minutes, and we'll be right back and go through the next segment of the show. I'm back. What's up? I'm back. Okay. So here we are. And they're taking me out. I want to go back to my chart. No, I don't care. Anyways, so the question before we went to break was, are a synthetic call and a poor man covered call the same strategy? Okay. Well, no, it's a synthetic call will give you unlimited potential profit. A poor man's covered call will cover up the amount of profit you can make. Okay, with the risk being the same. So again, if I were going to create, I hate to use this platform, but I have to use Thinkorswim for a minute, okay, because I got all my other stuff on my Tradier platform. But if I'm going to create a synthetic call or a synthetic stock, which is what I would create if I was going to create something that was that amount of trade. Let's just say that I'm going to do Apple, even though I would never. Well, Apple's not too bad today because their volatility. Apple's more like a utilities day, so their volatility is only 77%. I go out, let's say, to go out the next week and use the 192.50 as the midpoint. So I buy the call, sell the put, collar synthetic combo. And of course, I got to cover up my risk and my margin. So I would go down and buy a put, an Apple down below. Let's say I'll buy the 187.50. So right now I can buy the synthetic stock at about a $2 premium. And really what I've done here is I bought the 192.50 call. I bought it for $2. If you buy it on the board, you're paying $4 for it. So which is a better way to make that trade? Okay. Think about it from that perspective, which is a better way to trade, right? Yeah, I have a little bit more risk doing it my way, but I'm not worried about the risk. I'm worried about the profit. Okay. I'm worried about the time. I'm worried about everything else. I mean, if we sit here and do nothing, you lose $4. I lose maybe $1.90. Okay, maybe. Right? So again, remember, it's not only understanding everything, it's understanding what is the best option at the time you're putting on a trade. And that is something that you have to be prepared for and ready for and know what you want to do. Okay. And I think that these are, excuse me, things that too many of us didn't learn or don't pay attention to or don't really understand the proper usage. And the strategies that I'm teaching you are those of a market maker. I'm teaching you floor strategies, or now the computerized market makers of what they're doing. Because again, the key in business, the key in any business is risk management, right? Defense. In every walk of life, defense wins championships, right? Sports, money. And so you have to be able to identify the trade you want to make or the direction you can figure out, and then figure out what is the best strategy to use for that trade, for that direction. Okay. And which is one of the reasons if I'm actively, I'm always going to trade futures. If I'm day trading, I'm day trading futures. If I'm swing trading, I'm using a combination of options and futures. Okay. But you have to identify for you, what is your risk tolerance on any given trade? But if you're trading options, every option trade should initiate from around the money or at the money options. Okay. Now, those of you who might sell iron condors, well, you want to make sure you collect a big payment. You know, that those 90%ers are not what they're cut out to be. Okay. And I'm sure if you've traded them, you know what I'm talking about. And if not, someday we'll get into them a little bit. But I believe that you have to get 40 cents on the dollar on an iron condor, which means that if you sell a dollar wide iron condor, you got to collect 40 cents. Well, how close do you have to go to collect 40 cents? But it doesn't really matter, because what you already know is based on the at the money straddle. You know what the expectation of movement is. And after all, what else can we base our decision making off of? What is the expectation of movement? If we're selling premium, we need to understand just what is the expectation so that we're pricing accordingly while still getting enough credit to make it worthwhile for the times that it blows through one side or the other. If you're doing an iron condor, for example. Okay. So you have to be prepared on any case, on every walk. And again, the first thing to always remember to be prepared for is to limit the amount of risk that you're taking. And the way that you do that is you use a version of creating some sort of synthetic using the derivatives, using the option model to create that trade, not just straight buy a call or buy a put. And I'm not saying it'll ever work, because they do work, but overall, the amount of decay that people suffer, the amount of losses that are made because of lack of understanding of how to create, how to protect, and how to take care of the trade is far more damaging versus just learning how to put their trade on correctly to begin with. Okay, because we know that trading, there's going to be losses. Okay, they're not, every day is not Christmas. There ain't no free lunch. Right, so we have to be prepared for everything. So the trade setup, which is helping you determine your exit before you ever enter the trade, right? So again, as we're watching, and again, very quiet. We've had a very dull little session here. I'm keeping an eye on this while I'm with you guys, okay? And we'll switch back and forth. But I'm just trying to get an idea if there's anything for me to trade. And actually, right now, there's nothing for me to trade anyway. There is not a trade I'd be making right now, based on the very short term here, okay? But you can see, I'll tell you what, I'll bet you guys a cup of coffee or more that the Nasdaq will be positive before we get off today. Okay, it was down 100 when I got on. It's down 9 points right now, so it's gonna make a run. And I may not stay positive. The Dow, in fact, in the next 20 minutes, they could all be positive. Okay, we'll see. We'll see if I know anything. Probably not, but you never know. Take a shot. All right. But again, you look at crude oil; it's going straight up. Crude oil is up almost $2 now. So we're going to go back and probably test the highs made the other day at 82.43, if I remember correctly, and that's suspect. But let's take a look. I got to remember where I put these things. I don't put them in alphabetical order. I look at them a different way. And the high the other day was, it was 82.43. How about that? And I assume they're gonna make an attempt to test that. Okay. And I assume it's going to happen. Most likely, there's a good chance that it could happen today. Okay. And again, we'll see. But if you look at it objectively, okay, crude oil was on a little bit of support anyways. Crude oil was on support in a market that was trending higher, probably trending a little bit too quickly higher, right? The sustainability of any market, any movement, the steeper the rise or fall, the more likely you're going to see some retracement to the mean. Okay, let me say that one more time. The steeper the climb or the fall, the more likely there is to see a retracement to the mean. Okay, and if you're a Bollinger Bands fan, I use none, but if you're a Bollinger Band fan, that's what you will see. You'll see that a market gets overbought or oversold, and even if it's going to continue to go that way, this pace cannot be kept up. The market works best. Any trend works best at about a 45 or 50 degree angle. Okay. It does not work well at 90. Okay. That straight parabolic move is actually a trade to play against for a short period of time. It is actually called the blow-off trade. Okay. And listen, they can last for a little bit longer than you think. But if you look at like NVIDIA, just went off the top of my head, it's rallying today a little bit, but you could see. And it's kind of hard to see because let me change the time a little bit here. See if we can illustrate what I want you to see. Okay, here. You see what happened here? I already had it marked in. This is from a call earlier. And what happened? Well, it went into consolidation because this overbought or oversold condition can be resolved in a couple of different ways. It's either going to continue for a little bit longer, or it's going to fall down in this case, or it's going to consolidate. Well, here we got the consolidation. Okay. We got the consolidation followed by the down, right? So again, and that was not predictable, but it was predictable. You're not always going to be right, but what you want to do is you want to always be set up for the right probability, right? The probabilities told me that this was not going much higher than this at this time. Okay. Once it went into consolidation for a number of periods, it's now back in the same. It's a new trade once again. The old pattern was resolved by the consolidation. And if you remember that markets spend 65% of the time in consolidation. So it's not for you to tell the market when, but we can kind of see, looking at the phases of the market, when a move should stop or start to go in a certain direction. And that we're never going to get that immediate gratification. Okay. We're going to always have to wait. But the good trade, as long as you're playing good, solid defense and understand your risk and your exposure, then you don't have a problem. Okay. So as we look, again, we've got Amazon has earnings today. What are we thinking here? Well, I'm looking at Amazon, right? So I'm looking at this right now and I'm saying, well, they've already sold it off pretty good, right? It was up as high as, the last couple of weeks, up as high as 134. We're now at 127-ish, 128. If I look at it, I'm thinking, well, they probably priced in a lot of the news already. Now, have they? Well, there's no guarantee. But remember that with all technology now, most news is not news. Most news is just playing out. And when you typically get a big reaction off of a number or off of something, it's not because the number was that good or that bad. It's because the people that were speculating into the number overshot the mark. I don't know if you've ever seen, but there's times when people will be buying options. Everybody thinks that options are the least effective way to take a shot. Okay. They're buying calls, but they're not realizing is that the value of those calls are going up so far that even if they're right, they can't make money because the stock can't move as far enough as they're pricing in. And I'll go back, this is maybe 15 years ago, but Google was forecasted to have miraculous earnings. Okay. And they were buying calls like they were popcorn. And of course, Google did have miraculous earnings. The stock went up $50. And guess what? 90% of the call buyers lost money because they overpriced the buying on. Okay. So when you see super high volatility, it's hard for the stock to move that much. I mean, right now, Amazon is pricing in for today's move $7 between today and tomorrow, plus or minus. Okay. Not bad, 5%, right? 6%. Apple is pricing in for today. Oh, this was Apple. I apologize. Amazon is pricing in, that makes more sense, about 6%, 7%, 8%, right? So that we know what the street thinks price-wise. Okay? We know what they've priced in. And remember, calls and puts will equally expand for most of the time. Okay. So premium is going into one side, it's going into the other side. And that's how you get these skewed out of range volatilities where today Amazon's volatility is 144%, whereas normal is probably somewhere in the 40s. And these are important things to recognize because you cannot, if you try to be a buyer of weekly options in a stock like Amazon with this kind of volatility every week, it won't take you long before you lose it all. Okay. Because again, those options in the expiration cycle are meant to be sold, and you should be buying either weighted double diagonals or double calendars or something of that nature to capture that juice that they're pumping into it here versus what you're going to have, because the relationship and the values are going to continue to grow in your dated option. We know for sure that Amazon, Apple, all those weekly options must expire tomorrow. So they either expire worth something or worth nothing. Okay. Or somewhere in between. Right. So if they're over pumping air into them right now and they're overpricing them right now. Okay. Doesn't it make sense to sell those and buy something out that is more in what we would call reasonable pricing? I mean, that would be a greater thing for you to look at. And that is something that you need to learn. Otherwise, you could be dead right and still lose money because you have the wrong position on. And that's something that's very important to understand is not only do you have to have a feel for which way the markets are going to go, but have a feel for what is the right way to trade that position. And the right way comes down to what? Well, it comes down to your personal makeup. How much risk are you comfortable taking? Okay. In other words, not everybody has the same risk tolerance. So how much risk can you take? Because the amount of risk that you're comfortable with has to be commensurate with the trade that you make. Okay. Myself, I could trade the future naked one way or the other and not be bothered by the risk, where somebody else might have to put on a spread that the risk is defined and it might be a smaller risk. Okay. And that's what so it's not only deciding where we're going from here, but it's also then deciding once you have a direction, like once again, if I were going to trade Amazon, which I'm already in, I'm full disclosure, I own Amazon in my retirement account. I own Amazon in my short-term trading account, and I'm long. Okay, and I am long it through a synthetic stock. Okay, this trade I showed you earlier. Right. And I don't care. I'm not getting out because of earnings. I don't care. Okay, because I'll be right just as much as I'll be wrong, and I'm not guessing earnings. The pattern suggests that the trend is higher. Okay, and right now it's on support. And if I really wanted, if there was some real action in the market, I might buy more. But there's no real action, so I'm not going to get involved in a dull, slow market of what we're watching right now because it really doesn't make a lot of sense. Okay, do you have any questions? Anybody have any questions about any of that stuff? Because I know we're going to cut this a little bit short today because they don't trust me to be by myself because they don't have anybody hit the beeper button in case I go crazy. So we got about 10 minutes or so left, but no big deal. It just, again, if you have any questions, don't be shy and don't be afraid to ask them, and don't forget to hit that subscribe button as well so you get the updates. But again, on a day before a job is Friday, you don't expect much because there's too much sellers, too much buyers. They're kind of meeting somewhere in there, and they're kind of churning the market, all waiting to see what that number is. And that number tomorrow, when it comes out, you'll get, if you're an equity trader that's trading in a futures market, obviously, because you can't trade options at that time, but you'll get about 10 to 12 minutes to make any money. And then, of course, the market will go back to sleep until 9:30. But we'll be trading it live, so I'll be able to report it on Tuesday what we did. But at the end of the day, okay, again, you have to be prepared for all scenarios. But the biggest scenario that you have to be prepared for is the risk that you're going to take. This is a risk-based business, okay, and that's. I even remember. I like that, Max. I'm getting good. I even remember to put myself on by myself. It's a risk-based business. That's what we're looking at. Okay, and if we understand that part, then the rest becomes much easier, because if you're not exposing yourself to far too much risk, then your mind doesn't play tricks on you. You don't put yourself in bad positions. And trust me, we've all been there. Okay, I am not the perfect trader that's never done the things I'm telling you. In fact, the reason I get to share those with you is because I've done them, so I can teach you from the sweat off my own back and the mistakes that I made. Okay, and again, it's purely a matter of looking at markets, checking them out. It doesn't matter. They're all the same. Whatever you look at is fine. I mean, if you look at the grain markets, if you're a grain trader, well, here we are. This is an ugly market. They look like they're going to zero, but is 480 going to hold as support? That's what you'd be asking yourself. Okay. And what I'd be looking for is I'd be looking at when it gets to 480, I'd be switching over to a shorter term chart to see if it shows me on a shorter term chart that bottom's going to hold. I'm sorry, I forgot to share the screen. See, I bragged, Max, and now I screwed myself. There you go. There's the chart. Okay. There. So here I'd be watching. So now, if I'm watching this to make a trade, I'd be switching over maybe to a 5-minute chart if I'm using it daily. And until this starts to go up, there's no reason for me to believe that the longer term chart's going to change. Do you ever create option strategies where you can manage your downside to the point where you have to give up your profit but can exit at break even? Well, I do things like that. I try to do things like that. I mean, you can never guarantee anything. The only thing I can guarantee is how to minimize the amount of risk you're taking. I can never get rid of all the risk. But if you're trading, and it sounds like you trade a little bit more complex strategies, the one thing you can do okay, for yourself is if you're using the proper, what I call the at the money option strategy, right? Wait a second, where am I going here? Oh, you know what? The mouse confused me. I was watching too. Anyways, if you look at a trade, okay, and you set yourself up and you use the at the money option, which is what I teach you to use. Okay, when your 50 delta option gets to 80, you can roll it back to 50. Okay, taking out some credit and putting that in your pocket, so hence reducing the overall risk on the trade. Okay, so and we constantly do that. An option gets up to 80 deltas, I roll it back down to 50, take money, put it in my pocket, and now I've reduced the risk. In fact, every trade that I design on my Saturday options call, we reduce risk every single day. Every day, every week, we're lowering our risk amount, okay, and trying obviously get to the point where we have a shot at unlimited potential profit. But our first goal and our first objective is to reduce the risk on every trade. Because again, at the end of the day, this all comes down to money. Okay, that's the key. The trade comes down to money, right? Life comes down to money. So that's why we're here. That's what we try to trade, is about to get that money. Okay, so we want to make sure that we continue to take where we can. And if you just sell straight equities, you can't really take off a piece, right? You have to sell part of the stock. But in theory, if a 50 delta option goes to 80, I'm really just selling 30 shares of stock, if you look at it from a math standpoint, and I'm holding on to 50. And if it goes back up again to 80, I'll sell another 30, but I still got the original 50 I started with. So again, these are just little things for you to remember. And again, we'll get to all of it. Hopefully we got lots of time together. Hopefully I won't be one of those shows that get canceled right away, but hopefully we have a lot of time together. But at the end of the day, look, it's about discipline, it's about risk, and it's about putting yourself in a position. In today's position, again, as we look at the markets, as we get ready to say adios, okay, very much going on. I mean, again, here, just look at overall declining volume. So where's my action? Okay. Oh, thanks, Max. Okay. I mean, again, where's my trade? Anything I do here is a pure out guess. So if you have any quick questions, I'll be happy to take them. Otherwise, we'll call it a day, and I'll see you on Tuesday at 11 Eastern time. And remember to subscribe. It's free, and you get content. And listen, you get to look at me. What the hell? What's wrong with that? Okay. So listen, have a great weekend, everybody. Be careful. Remember, there is jobs tomorrow. It's going to be somewhat active, and the products that will be affected most, besides the indexes, will be gold, bonds, and the currencies. All right, adios, everybody. Have a great week. Have a great weekend. And football starts tonight, so let's go get them. Back to game.